Hey guys, it's Sasha, and today I want to share with you the 7 most important rules when it comes to investing in stocks. These rules are critical for solid long-term investing returns. Now, here is an important preamble. Every single rule on this list is stupidly simple. I am not about to sell you the magic formula for making 100% returns guaranteed on buying the latest meme stock, but what I will do is I will show you how hard it is to actually follow these super simple rules, because every investor thinks that investing is just super easy. I am guessing you already know all of these rules. But the fact is, the vast majority, we're probably talking over 95%, scratch that, 99% of retail investors will fail at following these rules over the long term. And the point of this video is to try and explain how to follow these rules, because that is the really difficult bit. And I really mean it. It sounds so easy, but then the time comes when you have to follow one of these rules and you go and act like a complete dumbass doing exactly the opposite, doing the wrong thing. So let's start with the first, maybe the most obvious rule: buy stocks when they are cheap. Now, I know what you're thinking. No shit, Sasha, you had me waiting for a whole minute to tell me this glorious nugget of information. But here is the thing. While buying stocks, while they're cheap, sounds super easy, this is the one rule that the vast majority of retail investors break. Because here's the thing. When a stock price is dropping, everyone starts panicking, acting like a complete idiot, and you begin hearing all of this bullshit like, don't catch a falling knife, because, as the knife is falling, if you try to catch it with your hand on the way down, you will cut it. And then there's the never-ending expectation that, of course, stocks are going to fall a lot more. In recent times, if you've listened to any of the conversations about the stock market, this is exactly what's happening. Stocks fall 10%, and of course, that is the start of a much worse fall. It's going to go down to 20%. Then they fall 20%, and of course, everyone knows for sure that it's going to fall down to 40%. They fall 40%, and everyone says this is the end of the world, is going to go down by 80%. It never stops. Just remember that the relative movement in the stock price is an irrelevant, completely irrelevant metric when it comes to making long-term investing decisions. If you are investing as opposed to gambling, your assessment should be comparing the current stock price to what you think a fair valuation of the company is. And if you think the current price right now is significantly undervaluing the business, and you believe that there is a reasonable likelihood that the market will eventually agree with this based on your future projections, and you believe that the risk profile around your projection is reasonable, then that's all that matters. It doesn't matter one iota what the stock price was yesterday, what it was last year. It doesn't matter unless the reason for the stock price falling changes fundamentally your view on what the fair valuation for the company is, changes your understanding of the company's fundamentals. Right now, loads of companies are selling at huge discounts compared to their valuations at some point during the last 3 years. Now, some of those companies are junk. Don't get me wrong. Some of them were massively overvalued for no good reason during COVID, sure. People were pumping near bankrupt companies like Bed Bath & Beyond and Tattoo Chef right here on YouTube. Peloton was really popular, the company that makes very expensive clothes hangers. It was valued at over $50 billion. But the whole market is down, still down right now, and there are many good companies out there that are also selling at a massive discount. And those stocks, in some cases, have huge upsides. But boy, do people like looking a gift horse in the mouth. You go and look at a stock, and you think it maybe has a 150% upside based on your valuation. And you sit there thinking, but what if it falls a little bit more? And I could instead get 160% upside. And then the price rebounds and you think it's a dead cat bounce, so you wait for the obvious fall that's going to come, and then 6 months pass and you realize that it wasn't a dead cat bounce after all, and the stock is now double what it was when you were being greedy. So yeah, buying stocks when they're cheap sounds easy, but most people will fail at this rule, as we've seen recently over and over, regardless. Which brings me to my second rule, and you probably can guess what it's going to be. Sell stocks when they are expensive. And at this point, you're probably thinking this video is a massive fucking waste of time because, duh, Sasha says you should sell stocks when they're expensive. How incredibly insightful. But here's the funny bit. This rule is even harder than the first one, especially in the last few years when so many young investors have decided that being an investor is a bit like joining a fan club of a company that you are investing in. You have these fan clubs all over Twitter of people who are the main cheerleaders of every stock. They talk about it non-stop every day. There's all these videos coming out multiple times a day. You know exactly what I'm talking about. They'll sing endless praises of the company in an echo chamber. It is illegal to say anything negative about the stock that you are a member of a fan club of. Every other company sucks completely. It's the worst, but their company's shit don't stink at all. And people have this belief that to be a long-term investor, you have to hold to the stock no matter what. You see all of these idiots on social media declaring they will never sell. There is a whole meme going around of the word HODL, right? Which stands for hold on for dear life. But the simple investing fact is, if you think a stock is overvalued, then you shouldn't be investing in the stock. That's it. End of the story. Every stock can be overvalued. Even the stock of a company that you are invested in or you are a big fan of. Sometimes a stock can become overvalued because the share price just happens to go up so much. I remember when many companies that I was invested in had their share price explode in 2021, for example. And I was selling out of many of my long-term positions, not because I didn't like the company or something changed in my perception, just because they hit my target price. I sold Nvidia. I think that stock went up something ridiculous, like 900% in 3 years. I sold Adobe. They went bananas, up 500% or whatever. If you don't have a price at which you will sell a stock, you are not investing. You are just in a fan club. Sometimes, though, you'll sell because the target price has actually changed. Maybe it's the macro environment. Maybe your view on the industry, your view on the company changes. Maybe the quarterly results keep telling you that you need to change your forecast. You need to adjust your understanding of what the future for the company might look like, whatever the reason. If you stop seeing an upside in the stock, why are you invested in it? Some people get upset because sometimes this means selling at a loss, and people think that's the worst thing ever. But remember that bit about how the share price from the past is irrelevant? Some people will sit on the shares of a company because they don't want to convert a paper loss into a real one. There is this mentality that if you sit on the stock, maybe it'll go back up at some point for some unknown reason, and then you'll sell and the loss won't be as bad. But you know what? It could just keep going down and down and down while you're waiting to reduce your losses, instead of being able to invest in something that you think should on average be going up. Which brings me to my next rule. You will lose money investing in stocks. And again, this one sounds so easy, but a lot of investors seem to think that the way investing works is you have to have a big win on every single investment you make, on every single trade. People have watched way too many movies and think that investing is all about these big calls that come in big and you go big or go home. But here is something you need to know. Even the best investors in history, the best investors ever with the best long-term track records, will still get 40% plus of their calls wrong. If you want to invest in the stock market, you better be okay with losing. It's like a game of snakes and ladders. You gradually progress through the game, but you are going to hit a few snakes along the way. Some people sometimes might avoid it, but generally speaking, the game is pretty big, the board is pretty big, you're going to hit them snakes. It's important to know before you hit a loser that you are going to hit some of those losers a lot. Because people absolutely lose their shit when they have a loser in their portfolio. Their mind goes completely nuts. They start breaking the second rule and not selling, despite every bit of data and evidence telling them that they should not be invested in a loser. They double down on the loser, buying the dip because, maybe it's going to go up. They hope the stock price goes back up. It's all something that sounds really funny, but just go and look at what happens every single day on financial YouTube channels. Nobody wants to show you their losers because it sounds so bad, right? It's the Monday morning gambler effect. You know that guy in the office who comes in and tells you about the big bet that they made over the weekend that won at odds of 10 to 1 or whatever, and they made so much money. And every Monday morning, that guy comes in and tells you about that big bet. And if you listen to them, it kind of sounds like this guy is the luckiest gambler in the whole fucking world because they don't tell you about the 20 other bets that they lost that weekend. It's super important to understand that you will lose. I've had a loser as one of my positions went down since I started on YouTube. I sold Palantir at a loss some time ago, and I've had plenty before that. And I'm going to have many more. Some of the big positions I'm currently invested in today, in my portfolio today, will turn out to be losers. Guaranteed. But this is where the next rule comes in. Stop buying shit because it's up and stop selling it when it's down. Now, this rule is almost a subset to the first two rules, but it's so important that I wanted to bring it out on its own. I'm going to explain because this is what I see happen all the fucking time. In the last few days, Bed Bath & Beyond, a company that is on the verge of bankruptcy, suddenly saw their share price go up by 200%. And suddenly, all the media started printing articles about them. All the YouTubers started making videos about them. It's all over social media. And all the gamblers suffering from FOMO went and started buying up the stock after it started going up, after it was already up. And then the stock, after these guys are all buying it, goes and dumps by 50% in a day. Now, we're all human, and humans have a set of rules coded into our brains. Those rules help us survive, help us figure things out that we've never seen before. One of those rules is extrapolation. We see a trend, a few data points, and we naturally make an inference that the trend of those data points will continue. It's very natural. And people see a stock price going up and up and up, and they fear that they're going to miss out on this massive opportunity. They don't give a shit what the company's valuation is. They don't have time to figure it out. They don't have any idea what a fair value for the stock is. Sometimes they don't even know what the company does. They just go and buy the stock because it's been going up. And exactly the same thing happens on the way down. In December, Tesla's share price crashed down to $100, a quarter of what it was a year ago or whatever, a PE of around 25 based on the last quarter's earnings for a company that is growing at 50% a year. And everyone on CNBC, everyone on YouTube was saying that you just wait until the share price falls to $60. A lot of people were selling at $100 because the stock was going down. There were fund managers coming out taking huge short positions publicly at $100 because, the stock is going down, so it will, of course, continue going down. But here we are, and the stock is now at over $200 as I'm recording this video. Now, it could fall again. I am not saying that it won't, but it seemed that everyone was so utterly convinced that the stock would keep on falling further and further and further just a month ago, and yet here we are. So please, do not pay attention to these random fluctuations in share price. Don't make investing decisions based on which way the stock moved yesterday, which brings me nicely to my next rule: fuck the moon. In the last few years, we've had these crypto bros shouting that the latest Dr. token is going to the moon. Remember all those fucking imbeciles with their laser eyes and their social media profiles? Where did they all go? Anyway, then we had these NFTs buying a fucking entry in a ledger with a link to a page where there was a JPEG of a monkey wearing a funny hat. You couldn't make it up. Then we had AMC and GameStop and blah, 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 whatever the latest thing is. There is a growing obsession in the world of investing with things going to the moon. And here is a bit of very friendly advice for anyone who actually gets impressed by all the talk of investing $100 into some utter garbage in the hope that it will go to the moon and make them a millionaire. Fuck the moon. 99.99 shitload % of things that you're told will go to the moon will never go to the moon. Last year, a bunch of degenerate gamblers were telling you that worthless tokens named after Elon Musk's dog are the next biggest thing. This sounds so ridiculous, and if this wasn't true, it would sound really fucking dumb, right? All the big YouTubers told you to go and buy some. Graham Stephan was on the hype train. Andre Jick was on the hype train. A million other smaller YouTubers were on that same hype train. And then that train derailed. And the saddest thing is that it was so incredibly obvious at the time. And yes, I even made some videos at the time warning people. Then there was everyone tripping over each other with FOMO to short squeeze the hedges. And the moment AMC hit $25, it went nuts. It was front page news of major newspapers. I can't remember a single big YouTuber who wasn't licking the backside of the ape movement. And of course, that shit show is now down 90% from when everyone was trying to tell you to buy it at $50. There are endless other examples. Every now and then, there will be a company that will really take off from nowhere. It's rare, Most companies have the explosive growth stage before they become public, but sometimes it does happen. And when it does happen, nobody pretty much outside the company usually has any idea it's going to happen before it happens. Most of the companies that do it are not the sexy popular stocks that everyone is talking about. Certainly not investor kids in a fucking subreddit. So please, do yourself a favor. Never chase anything going to the moon. Because believe it or not, but returns of between 10 and 20% a year on average from the stock market are actually really good. Please ignore the imbeciles with warped perceptions that investors should be making 100% in 3 months or whatever along those lines. And while we're on this theme, you probably shouldn't be buying stocks. And yeah, this is such an unfortunate truth, and I'm really sorry to break it, but in reality, this should be a rule for the vast majority of investors. Over 20+ year periods, around 95% of actively managed funds lose to the S&P 500. So 19 out of 20 investment funds spend their entire working days analyzing data. They have armies of analysts with the most fancy education. They spend a fuckload of money on computers and AI and blah-de-blah, and they still make less money than if they just put their money in the S&P 500 on average. So the unfortunate truth is that if 19 out of 20 fund managers suck balls at beating the market, it probably means that a bunch of you guys, probably a much bigger bunch of you guys, including me, will probably also lose to the stock market. Now, I know that you probably heard this one before, and yet here you are, watching a YouTube channel talking about investing, and I'm betting that you hold at least some individual stocks. I do. So although you know that you would probably be better off just investing in the index, the chances are that you're gonna go and buy those individual stocks anyway. So given that you're going to do it, I'm probably not going to change your mind on that one, but while you're doing it, I just want you to think about it and to remind yourself that you are knowingly going out and buying individual stocks and what that implies. As long as you have thought that through, and as long as that thought is at the forefront of your mind, it might just make you think a little differently about some of the choices you make and some of the ways that you manage your money. And as you get older and wiser, you might adjust your strategy. I know you think you won't, but let's see. Part of that adjustment will be to stop your stock market obsession. And I know I am part of this problem. I sit here talking about investing in stocks and all of this stuff literally all the time. It's kind of my job, so that's why I'm doing it. And you're here watching. But the truth is, people waste way too much time obsessing with the stock market and trying to consume content about stocks. People will often spend hours every day doing this, watching all their favorite channels. And at the end of the day, those hours are spent in the hope of maybe increasing your investing return by a few percent, right? That's the sort of the benefit. I know that probably you're watching them for entertainment value, but you're probably telling yourself that, there's educational, informational value in it as well. But here is what you should do instead. Pick your strategy for investing, lay out your approach, invest your money, and then use those 2 or 3 or whatever hours a day to go and learn a new skill. Go and start a side hustle, start a little side business. And if you invest $200 a month into your portfolio, say today, and then you manage to increase your returns from 10% to 20% per year because you've been watching all of these YouTubers telling you their secrets, if that happens, then at the end of the year, your $200 will become $240 instead of being just $220 at 10% return. But you could just decide that you're happy with a 10% return, like a complete numpty, not being super amazing with your investing. And then you can go and spend all of that time on your side hustle, which then means that instead of investing $200, you could invest just $250 a month, just $50 extra into your portfolio. And after adding the 10%, your $250 becomes $275. So your portfolio will be $35 better off. So your return there will be almost double the 20%. Think about it. Then just think what happens when the compounding effect hits as well. And suddenly, when you actually think about it, you might begin considering your investing strategy in a very, very different way. If you found these rules useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it. And as always, I'll see you guys later.